Welcome to another Southbank investment bulletin. So there's something that's always been at the center of how I look at markets, and it's a simple expression. It's capital is global and mobile. So the most important thing to remember is that the Bank of England might be raising rates and reducing the size of its balance sheet. So is the Federal Reserve, so is the ECB. But Japan's not doing that. Japan hasn't raised rates. They've been tinkering with the level at which they're willing to intervene to suppress the government bond yield, but they're still engaged in quantitative easing, which means they're printing more money. Now, the next big question is what happens next in China? So it's almost like every day China is announcing a new suite of measures to try and support the property market. Now, we haven't seen a big move yet in what in the quantity of money they're willing to supply or a devaluation of the currency. Because we know that whenever quantitative easing gets going and they really start moving in terms of printing more cash, well then greater supply represents a downward trend for a currency. So one way that we can really monitor exactly what's happening in terms of just how much money all of these additional measures that the Chinese government are introducing to try and support the property market is via the currency. Now, this is the renminbi relative to the dollar. So when this trend goes up, it means the dollar is going up relative to the renminbi. And we can see right now that the 730 area is just about where the dollar peaked back in October of 2022. And if we look at more back history, well, then we can see that the dollar trended higher all the way through 2022, but then it trended downwards all the way from 2020. And of course, that was in response to the vast quantity of dollars that were printed during the pandemic. Of course, the more back history we look at, then we can really see that there have been plenty of times, particularly in the 1980s and early 1990s, that China was depreciating its currency. In fact, they got their depreciation in the early 1990s, and most of the other Asian countries didn't devalue their currency until the Asian financial crisis in 1997-98. But I think it's quite clear from this longer term chart that there's an upward bias to trading over the last 5 years, and it does look more likely than not that the renminbi will get weaker. But of course, that also implies that the Chinese government is going to supply more cash. Now let's also look at, for example, uh, the companies in Hong Kong that are not so much Hong Kong companies, but Chinese companies listed there. So the China Enterprises Index, it's called the H shares, it's bouncing from the 6,000 level. Now it's not doing so in a particularly dynamic manner. So we're still seeing more money getting printed, but it's just not moving the needle just yet. But it's going in the right direction. And that's important because that money that gets printed in China isn't going to just stay there. It's going to go off and it's going to buy things. So it's going to buy things like copper. It's going if they decide to put more money into infrastructure, which is what they've always done, well then we're going to see copper prices doing better from here. And of course, if copper prices are doing better, well then a broad measure of miners should also start to improve. And for example, the BlackRock World Mining Trust is steadying in the region of the 1,000-day moving average. Now that would be just a pure liquidity play. But then we do have what's happening with the oil price, and Brent crude is continuing to firm. Now, it popped on the upside last week. It made a new recovery high. I think the most important thing here is that the downtrend has been broken. So we got a big spike in activity immediately after Russia invaded Ukraine back in 2022. Since then, prices came down. And now that downtrend has been broken, it's a new recovery high. So the sequence of lower rally highs has, without question, been broken. The moving average, 200-day moving average, is turning upwards. The price is finding support in the region of the moving average, and that's a dynamic move on the upside last week. Something that has been quite clear is that the pronouncements about supply cuts from OPEC Plus have been coming at the beginning of the month, and the beginning of September wasn't any different. Last week we saw that Saudi Arabia extended the cuts that they're willing to implement. So they're going to keep their current level of lower production going well into October. And there's a strong possibility that by the time we get to October, they'll be announcing the same thing. Now let's also just pay attention to the fact that the price bottomed in the summer around the $71 level. And when we look at the EIA report from last year, well, what they basically said was that the break-even point for Saudi Arabia and its crude oil was around $73. So those lows, which were never held, were right around where Saudi Arabia wouldn't be very happy with prices falling below it. And then we've had this big rebound. And now, because of lower volumes, they need a higher price to balance their budget. But the upper boundary of where it's profitable for Saudi Arabia is around the $85 level. So at $88, they're making money. Now they might like a little bit of a cushion, so they might like prices to go up to $100. But of course, the higher oil prices go, well, then that creates an inflationary problem for consumers. And this is where we're going to potentially see some inflationary pressure starting to come through. If we see China printing more money, then that's going to inflate asset prices. If oil prices continue to rise because OPEC Plus continue to moderate the supplies situation, then we're going to have some inflationary pressures continuing. Now that's going to be problematic. So then the potential is that interest rates will stay higher for longer. Now, what that is basically a recipe for is stagflation. Stagflation is where inflation remains high but growth moderates. And that is potentially what we're looking at right now. Now, it's particularly a problem for consumers. So, consuming nations are certainly predominantly in Europe. The USA is mostly energy independent, so is Canada. But the FTSE 250 has been quite resilient, and it is steadying at the lower side of the range. But there is a downward bias to trading. So in order to really confirm that we're back in a demand-dominated environment, fueled by potentially liquidity coming through from China, then this index is going to have to at least sustain a move up through the peaks that were put in back in July. And that's at least another 1,000 points from where the level is right now. But then there are other countries where they would benefit enormously from a stimulus in China. So the DAX index is right in the region of its peak. And of course, there are lots of German companies with very substantial business interests in China. So the DAX is still steady in the region of the 200-day moving average and the region of the peaks from back in 2021. And then, of course, we are still in an environment where the Nasdaq is very steady, and it's also right in the region of its peaks. Now, we've had a bit of back and forth action over the last while, but the linkage between liquidity provision and the outperformance of the growth sector has been absolutely evident over the last 15 years in the aftermath of the credit crisis and the advent of quantitative easing. And that's likely to persist until we see that this outperformance of the mega cap companies ends. But as long as there's money being printed, then that's likely to, somewhere that's likely to be a bullish phenomenon for the large companies on Wall Street. But ultimately, it's going to force central banks to continue to raise rates. And this cozy situation, which is supporting asset prices in the present, isn't going to last indefinitely. But we can give the benefit of the doubt to the upside until there's clear evidence to the contrary. And I think with that, I'll leave you for this week, and I'll wish all the best to all of you.